How to stop emotional investing. Active portfolio monitoring is essential for navigating the changing tides of financial markets. Individual investors must also manage the behavioral impulses of emotional buying and selling that can arise from following the market's ups and downs. Indeed, investors appear to have a knack for piling into investments at market tops and selling at market bottoms because it is common to become entangled in media hype of fear, buying investments at peaks and selling during cycle valleys. Risk can be used to guide investing and investing behavior. Investors who enter into investments with a basic understanding of the risks involved can reduce a lot of the emotion that comes with investing. In other words, challenges due to emotional investing can arise when investors encounter unknown or higher risk risks than they had anticipated. So, how can investors navigate volatile markets while remaining calm and diversifying their portfolios for the best overall returns in all market conditions? The key is to understand the motivations behind emotional investing and to avoid both euphoric and depressive investment traps, which can lead to bad decisions. Let's list out the things you can do in order to stop emotional investing. First, you have to be aware of the bull versus bear market. Bull markets are times when markets rise relentlessly and at times arbitrarily. When the bull runs wild and investor sentiment becomes euphoric, investors may see market opportunities or learn about investments from others, such as news stories, friends, co-workers, or family, which may compel them to venture into uncharted territory. The investor's excitement may lead him or her to try to profit from investments that are emerging as a result of bullish market conditions. Similarly, when investors read about a bad economy or hear about a volatile or negative market period, their fear of losing their investment can fuel selling. Bear markets are always around the corner, and they come with their own set of risks that investors must be aware of and understand. In contrast to a bull market, financial markets can sometimes trend lower for months or even years. Bear markets frequently emerge from an environment of rising interest rates, which can encourage risk-off trading and a shift away from riskier investments like stocks and toward low-risk saving products. Bear markets can be difficult to navigate when equity holdings lose value and safe havens become more appealing due to rising returns. During these times, it can be difficult to decide whether to invest in equities at market lows or in cash and interest-bearing products. However, sometimes it's just really bad timing. Emotional investing is frequently a bad market timing exercise. Following the media can be a good way to detect when bull or bear markets are developing because daily stock market reports feed off the activity that occurs throughout the day, which can create a buzz for investors at times. However, media reports can be out of date, ineffective, or even illogical and based on rumors. Individual investors are ultimately responsible for their own trade decisions and must therefore exercise caution when attempting to time market opportunities based on the latest headlines. The key to evaluating interesting opportunities and resisting bad investing ideas is to use rational and realistic thinking to understand when an investment may be in a development cycle. Reacting to breaking news is likely a sign that decisions are being driven by emotion rather than logic. Dollar cost averaging and diversification, two of the most popular approaches to investing, can take some of the guesswork out of investment decisions and reduce the risk of poor timing due to emotional investing. The dollar cost averaging of investment dollars is one of the most effective. Dollar cost averaging is a strategy that involves investing equal amounts of money at regular, predetermined intervals. This strategy is applicable in any market condition. In a declining market, investors are buying shares at ever lower prices. During an upward trend, the previously held shares in the portfolio generate capital gains, and because the dollar investment is fixed, fewer shares are purchased when the share price is higher. The key to the dollar cost averaging strategy is consistency. Set the strategy and stick to it unless a significant change necessitates revisiting and rebalancing the established course. This strategy works best in 401k plans with matching benefits, where a fixed dollar amount is deducted from each paycheck and the employer contributes additional funds. Diversification, or purchasing a variety of investments rather than just one or two securities, can also help reduce emotional reactions to market volatility. After all, there have only been a few instances in history when all markets moved in lockstep, and diversification provided little protection. Using a diversification strategy provides some protection during normal market cycles because losses in some investments are offset by gains in others. Diversifying a portfolio can include investing in different industries, geographies, and types of investments, as well as hedging with alternative investments such as real estate and private equity. Because different market conditions favor each of these investment groups, a portfolio composed of all of these different types of investments should provide protection in a variety of market conditions. Investing without emotion is easier said than done, but there are some key considerations that can keep an individual investor from chasing illusory gains or panic selling. Understanding your own risk tolerance as well as the risks of your investments can provide a solid foundation for making sound decisions. Active knowledge of the markets and the forces driving bullish and bearish trends is also essential. While active and emotional investing can be profitable at times, data shows that sticking to a well-defined investment strategy and staying the course during market volatility often results in the best long-term performance returns.